Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest for episode 257 is Austin Masket. You'll hear from him soon, but he is from Millichap, and they are an investor-backed, data-driven real estate investment firm with a focus on multifamily and storage. We also talk about his history as a commercial broker and how it helped him get into the business right now. Let's go. This is episode 257 of Zen and the Art of Real Estate Investing with my guest, Austin Masket. Austin is a fund manager, founder, and the chief investment officer of Millichap. He brought over $1 billion in transactions from his former real estate positions to that place. Austin, welcome to the show.
Hi, Jonathan. Thanks for having me.
Yeah, excited to talk a little multifamily and syndications with you and get your background. I know you started as a broker. Was that when you were interested in real estate, or were you interested when you were younger as a kid in real estate?
Yeah, so I kind of grew up in a real estate family. Remember very young going to showings, trying to rent single family homes with mom and dad.
Nice.
So did a lot of that, and out of school just kind of clicked to be able to hop into brokerage. Started at Marcus and Millichap, like so many of us do, and really that really gave me the financial footing to get into syndication and be an investment director or portfolio manager for family offices.
Yeah, were your parents brokers or agents, or were they investors, or both?
Investors, kind of smaller investors in Southern California.
Yeah,
did well there. So that's where I grew up, but been in Denver since 2007.
Yeah, when you were, because I grew up with a dad who dragged me to literally everything as well. Were you interested in it, or it just become something that you kind of learned through osmosis? Because that's how I always kind of had fun, but some days I just would rather go play basketball. But then I realized, wow, just being there, I learned a lot, tenant relationships, landlording, all of those things. How was it for you?
Yeah, it was similar. I think no kid loves to go to house showings, especially when it's the same house every time.
Yeah,
right?
yeah. Like, let's get this place rented.
Yeah, right. I don't want to do this again. But when you get older, you start to realize, what it is your family is doing, and the incredible value that comes along with being a landlord, and all the rules and of engagement there as well. So. And the later part of my childhood certainly became very interesting. Is that kind of similar to you?
Yeah, very much. I started being the rent collector as I got older and was able to interface with tenants and things like that. And then I started to understand it more also when I saw like picking up rents, and then I would look at the books and really is like, oh, okay, this is a real business. My dad showed me the book, so I realized it was a business. Were you looking at it like, hey, this is something that I could do later? Because you went right into real estate, but it's investing. Like back then, I never thought of myself as a real estate investor, and a lot of like old schoolers didn't either. Now everybody, you get like a whiff of real estate off of a podcast, and you're a real estate investor, now. But I think it was different back then. How did you see real estate in the future? When you were around 18.
At 18, I guess it was really more of the family business at that point. I was busy going to college and, doing that, and really not sure what I wanted to do. And then sort of as I was wrapping up college, I decided, this is the thing that makes the most sense. I've got some decent experience, at least enough to get a entry level job as a broker, and went and got my license. And, I found that being on the job, being in the office with some of the big wigs, if you will, of the Denver office of Marcus and Millichap, really exploded my knowledge of the industry and what a good deal is, what a bad deal is. Because I think at that point, my family hadn't, bought or sold anything in, 5 or 10 years
Yeah.
probably.
Yeah. But it's interesting, though, because a lot of people go to residential just because they assume it's going to be easier. I've been licensed for 10 years, do both, but I've never practiced at a commercial brokerage. You went right to a commercial brokerage, which gives you access to bigger deals, bigger people. And I think what I would consider a different type of networking, because commercial real estate is all people to people. It's not really like looking on Zillow. Why did you choose commercial at that time?
Yeah, I like the more sophisticated clientele.
Yeah.
I think I was more interested in the investment of it versus a place to live, which is
Yeah.
more on the residential side. So that really got me into the syndication side. Started to work with some of those guys, buying and selling their deals, and that really got me excited to jump into that side, and that's what I did.
Yeah. Awesome. And so how did it parlay from there? You started at Marcus and Millichap. I know you went to a couple different places and you started playing with different assets and they kept getting bigger. How did it grow? And then how did you end up coming up with Riverly Cap?
Yeah, great question. So I was at Marcus for a solid year, and then was able to parlay that into a sort of portfolio manager position with a family office called MS Holdings,
Yeah.
a smaller family office out of California. Worked there for better part of 10 years, just helping them buy and sell the right deals and get into all kinds of different multifamily projects. And so did a lot of that. And over, I would say, COVID and when the boom and bust of commercial real estate
Yeah.
over that period, we all sort of took a step back and said, "Hey, these prices aren't sustainable. Something's got to give here." So we didn't buy a whole lot then, and didn't really sell anything either. And then just last year, as the market opportunity started to show itself, I finally gave MS Holdings the handshake and said, "Hey, I want to go off and do my own thing," and so that's what I did and started Riverly.
Yeah. Awesome. And I know I was reading from stuff that you sent in advance that what do you think syndicators did wrong? Because I know you've been watching the market for so long and there's been obviously bad press on what syndications have done, but it's not everybody. But there's a certain formula, I think, that made up bad deals. And I know you know a lot about this. So what do you think was the problem with people making the bad deals, the ones who are stuck now with capital calls or assets that are underperforming?
Yeah, so I think there's a couple of things that happened. One is money was just easy to get. Everyone was terrified that their money was going to turn into just become worthless in the bank, right?
Yeah.
And to a certain degree, it was. So they were just pushing it out to just buy anything, right? So there was too many dollars chasing too few goods, and so the prices of assets went, through the roof, basically. And then the other part of it was the tail end of our cheap money economy. So the economy was essentially built on cheap money since 2008.
Yeah.
Obviously not news to I think most of your listeners,
Yeah.
but yeah. So then when COVID hit and Jerome Powell dumped interest rates even lower to do anything and everything to pump up the economy, it just created this perfect storm of tons of money buying whatever deal, didn't matter, and syndicators had money coming out of their ears, and had a lot of pressure to go put it to work, whether that they had a good deal or not.
I
And
think everyone
what
had
I've found,
yeah, go ahead.
go ahead.
Yeah. I just feel like everyone had a lot of time on their hands too, because for at least the first 6 months, we were kind of all locked in. So for the investors, like they were hyped up. They did all day was think about, hey, what are they going to do with my money? And then syndicators were almost pressured into go finding deals when you really couldn't look as much in the beginning, at least as we used to be able to.
Right. That's the other piece, right? You couldn't even do due diligence.
Yeah.
That wasn't available in the market because there were so many people interested in just saying, "Yep, we'll close tomorrow,
Yeah,
all
right.
cash."
Yeah.
Right? We don't care. The condition doesn't matter, right? Well, that came back to bite a lot of people. I
Yeah.
think.
That's a good point, though. Because I've talked with so many syndicators, and I think over time the PDF deliverables became so good looking, although they may not be realistic, that a lot of people took everything that comes in the prospectus at face value. But that goes against old school real estate, which is you want to kick all the tires all the time just to see if you can get a better deal on it. But as you were saying, like everyone's cooped up, they need to port their money. So a lot of people are making quicker decisions than maybe they should have, right?
Hmm. Absolutely. Yeah, definitely a bit of that. And, you know, ultimately the interest rate environment wasn't sustainable. Rates are where they are now, and the pain has come, right?
Yeah. Well, I mean, it's funny though, because historically rates are fine. It's like that because they went so low, these weird expectations of where they should go now. When a lot like I'm old, so I look at it and realize, people that I knew had 15%, mortgages on regular houses and commercial rates were high. So now it's just, I consider the rates because, of course, it played a big role. But don't you think that most of the people who were just steady looked at the rates as just another thing on the spreadsheet to evaluate?
Well, so the way that, and I'm sure you know this, and most of your listeners do too, but the way that you make money with commercial real estate is the delta between cap rate and interest rate,
Yeah.
right? So at the time, if you were buying a 4 cap, but your interest rate is 3, like you're chilling, you're doing great,
Yeah.
no problems there. But now in 2024, your loan is coming due because you only get 5 years and you need to refinance at 6%, but you're still running at a 4% cap.
Yeah.
Now you're negative leverage 2 points. That's going to hurt. You're probably not going to be able to hold on to your deal. And most likely the bank is going to say, hey, yeah, we'll refinance this for you, but you need to hand us, $3 million in cash to pay down
Right.
your loan. And so that's where the capital calls are coming from. And yeah, I'm sure you've had, gone over that story quite a bit.
Yeah, yeah. I mean, but it's relevant because it's really not going to stop now, and there's certainly ways to avoid it. But I think when you look at that scenario, like you said, the cap rates got compressed, and it's like people should have been able to see this. Sure, it's great now, but why was it? Who thought that rates were just going to stay at 3%? That's just insane. Historically, it's literally insanity. So I think that
Right.
again, it was that, hey, a lot of time on their hands. Let's put them things in. And I think people, they reach too far probably, and the investors are paying for that now.
Yeah. Well, I think anytime the economy looks as if it can't ever go down, that's when it's about to
Yeah,
uh,
that's a
go
good
down,
point.
right?
Yeah, yeah. Hopefully, we can get a little bit of the opposite now. But that's an interesting corollary to what's going on now, because you look at the market now. We're still. I think like a year ago, everyone was saying, "Hey, well, sellers at some point are going to have to get realistic, so they start coming down." But I still haven't seen it as much. What are you seeing when you're out there looking at assets? And do you have to just be more patient than you used to be and look at a lot of deals, but pass on a lot of deals?
Yeah, we are passing on a lot of deals. I think mechanically, there's just a lot of deals out there that don't mechanically work. So
Yeah,
if you're buying studios and 1 bedrooms in, a suburban market, that can't work. If you think about, let's say most of your tenants are making, $15 to $20 an hour, a $1,500 a month 1 bedroom, it's just the math doesn't work for them. So they have to go into a two for 1,800
yeah,
or 1,900. That changes the economics significantly for them. So your demand for 1 bedrooms is waning. And then let's say you are making enough money to afford a 1 bedroom, you can probably afford a two, and maybe you work from home and you want a two, you want to have an office.
yeah.
So the demand for ones and studios almost completely evaporated, right? And where they used to work in very core markets, they no longer work because no one wants to be there because no one has to go into the office anymore,
Yeah.
or a lot fewer people do it than they used to. So we're looking heavily at deals that are, twos and up. Obviously, we want to get the highest grade asset for the least amount. But generally, what we do is we look at deals that, are mechanically, the bones are there. There's minimal ones. There's mostly twos, threes, what have you. there's an opportunity to upgrade as far as either putting washer and dryers in the units,
Yeah.
or some kind of meaningful unit upgrade there. And then we're trying to stay away from, major capex on the exteriors, but we will do it if the deal makes sense. What a lot of people are trying to do is sell, pump rents as much as possible without doing the big capex
Yeah.
projects, and sell it for top dollar, and we're not buying those deals.
Yeah, and I think those will sit around. I mean, I feel like because so many people reached at the time we were talking about, kind of that's not out there now. So it's experienced operators passing on a lot of deals. And as I said, I think a lot of people are just, you must be looking at deals like, when are they going to get this? This has been sitting around for a year. They're still stubborn on their price. Like, do you need to sell or not? They're in trouble. At some point, it's just going to come to a head and they're going to have to take way less instead of kind of negotiating reasonably along the way.
Yeah, that's where I think I'd love to kind of dive into where the market conditions are now, and see what, based on the data, what my predictions are, and I think it's going to be different for every property owner. But yeah, let me jump into that real quick.
Yeah, because you think distressed assets are coming out more and more in the multifamily space. Hopefully
they are, but the timing is going to be very short for those, and I'll tell you why. So basically, in 2024, there was 518,000 new multifamily units delivered nationally. That was a 30% increase from 2022 and a 9% increase from 2023. And if you look back at the graph, that's the highest year in deliveries and since 1986, which is, as far back as my data goes.
Yeah.
So it was one of the highest years as far as new delivery. So there is a boom in supply. And as we all know, with capitalism, supply is higher than demand, prices go down, and vice versa. So that's happening in the market now. Rental asking prices are down nationally on average about $50. What that means is vacancy is up. New properties are giving 10 weeks or more of free rent just to get tenants in and try to lease up their properties, because there's just so much supply out there. Denver, where I'm at, is one of the worst cities because we're kind of losing demand, and we have more supply than a lot of other major markets.
Similar, a lot of places in Texas as well, some in Florida, right? I mean, these are similar types of markets where the building was hot and then it was like, oops.
Yeah,
exactly. Yeah.
So obviously there's a lag time between when a property breaks ground and when the actual units are delivered to the market for rent. So everything that was delivered in 2024 started construction in 2022. That's when they broke ground, roughly. It was about a 24-month lag. And that's when interest rates were low. Everyone thought this is going to keep going forever. Let's build as much as we can because the demand is insane, right? And so that's what happened. And now we're kind of feeling the effects of that. So now, fast forward, we're in 2025 now, and we're still at a pretty high rate of deliveries. It's going to be a little bit lower than 2024, but still high. And then in 2026 and 2027, that's when deliveries are going to fall off a cliff. Because if you think about the lag time, anything coming online in 26 and 27 was started in 24 and 25.
Yeah.
So interest rates are where they are. It's very difficult to pencil a deal at a 8% construction loan to get it out of the ground. So that's why basically the supply is going to shut off here.
Yeah.
But what's happening is we have 570 billion in debt coming due in 2025. And a little bit less than that in 2026. Those are the loans that people took out in 21 and 20 buying over leveraged distressed properties.
Yeah, good rates that are now due to be repurposed into not good rates. That's the big deal, right?
That's the big deal, right?
Yeah.
I mean, so like 23 and 24, we did see some cracks of distressed properties, distressed debt coming due, and actually some of our team was able to take advantage of that, and so that's why we brought him on in Riverly to make sure that we have the experience to make it happen on the distressed debt side. But that said, this next 6 months to a year is going to be the boom of distressed debt. So that's what we're looking at. What's going to happen after that? Well, like we said, 2026 and 27, the supply shuts off, right? But we are absorbing those units quickly, actually more quickly than people thought. So as a country, obviously every market is different, but those units are going to get absorbed. And then in 2026, late 2026, 2027, rents will go up. It's just a factor of supply and demand. Basically, housing supply doesn't wane or wax or wane. It just moves around, right? Or sorry, demand. I mean,
yeah,
moves around. So depending on the market you're in and where you're at, those changes are going to happen.
Yeah, it's interesting in some of these bigger markets that have an oversupply, but then we still, watch the news and say affordable housing crisis, nobody can find properties. But a lot of a lot of people I've had on are saying, well, yeah, all the new builds are A class, and not everybody in that category can get to A class. So there is opportunity there to buy some of those B and C that can get upgraded. Is that the type of thing that you're looking at as opportunity, or are these going to be A classes that didn't finish or couldn't really complete what they expected to complete?
Yeah, so it's a bit of both. We're pretty opportunistic as far as what kind of distressed debt. So what we're looking at now, instead of buying the actual property, we're buying the debt itself.
Yeah. Okay.
From the banks, and we've got some good relationships with some of the banks to make that happen. But basically, once you do that, there's two options, right? One is it's non-performing debt, so you're going to buy it for 50 to 80 cents on the dollar.
Yeah.
As far as what's owed on the note. But once you do that, there's two options. You can either foreclose on the property if you can't get the debt performing again, or if you can get the debt performing again, then you can sell the debt back to, one of the large banks. So
yeah,
that's the strategy we're going after. Like I said about the supply tightening up in 2026 and 27, the timing, there's not a lot of time left, right? I believe Jerome Powell will be removed in June 2026, and rates will go down significantly then. So in the meantime, there's some opportunity. Past that point, I think we're kind of off to the races again and buying market level deals because there won't be many distressed deals left.
Yeah. Okay. That's interesting. We've talked foreclosures a lot with, single family home buyers and people who trade in distressed small assets. But when you're buying an apartment building, I would think that the foreclosure process is it's difficult for just a regular, a condo. What does that entail? And are you looking to avoid that and kind of just figure out what you can do with the property with the debt because you got a good deal?
Yeah. I mean, we'll do whatever it takes. Every state is different as far as foreclosure process. Some states takes 6 months, some states takes a month. Texas is a great market for that. Florida is not. Colorado is tougher as well. So it just kind of depends on where you're at. For us, it just comes down to having enough capital to be able to, run the gambit and pay whatever it takes. A lot of times it does mean, going to probate court and figuring that whole process out. But we've got a pretty good track record with some of our guys on the team to make that happen.
Yeah, it also seems like purchasing the debt out right now is more complicated than just a traditional deal. So it's not going to appeal. There's not going to be the same amount of people in there to try to do it. Does that help you get leverage to get better deals on the debt?
Absolutely. Yeah. We're usually competing with 3 or 4 other groups at the most, versus on a, marketed multifamily deal, you're probably competing with 30 or 40 easily. Yeah.
But the deals that are at least, mechanically penciling now on this debt side, What was the issue? Is it just because they bought at a low rate and now the 5 years is up on their rate and they're going to have to refinance at, 7, and they just can't do it because the cap rate's still low? Or were there other factors in terms of, not necessarily new builds, but I know a lot of people took, builders loans and they weren't able to even complete the cycle of renovations that they thought, and the property kind of sitting in limbo.
Mm-hmm. Yeah, it's definitely a bit of both. We put a deal together last year where it was a rehab. Kind of they bought it in early 21 and tried to flip the units and get them refreshed and re-rent them again, and they just didn't do a great job and weren't able to make it happen, and defaulted on the debt. That one was in California. But we had to pay, because it was such a good core area, we had to pay 97 cents on the dollar for the debt.
Yeah. Yeah. I mean, but that's understanding the market and understanding what the deal is in that particular market.
Exactly. Yeah. I mean, when you underwrite with debt, you're still underwriting you're still underwriting the property, right? At the end of the day. And it's the same thing. Like, anytime you go and buy a multifamily property, your bank is going to run a full P&L just like you would as you're, figuring out if this is a decent deal or not. The same thing applies with debt. And we try to buy the debt at a point where it's basically like a 6.5 cap deal. And if we have to go more than that, we usually say, let us know what other offers you get, and then maybe we'll compete, kind of thing.
But does the apartment unit count, the bedroom count, and these things, and the demographics of the area and the traffic patterns and stuff, does it matter as much when you're buying debt as if you were actually just buying that outright, for a syndication deal?
It does. Obviously, there's a capacity for any property to bring in income.
Yeah.
No matter what it is, right? So if it's all studios and, it's in a rougher part of town, there is a market for that. You might have very high vacancy. So if you need to underwrite 20% or 30% vacancy, then that's what you do. And then there's a price for the property where it makes sense.
Yeah.
If it has the capacity to take on renters, then there is a value. Has to be.
Yeah, I wanted to go back to kind of the way that you started when we were talking about commercial real estate, and because you went right into it, and that commercial is just very much a relationship business, where residential is kind of just an asset business. I mean, the relationships are important, but it's not the same because there's so many realtors. But when you're dealing with things like this, distressed debt, that's going to be all relationships. You have to know people. It's not like, a random person from, New York City is just going to pull up and find, hey, has anyone got some distressed multifamily debt in, Toledo? They're not going to have access because they're not a trusted, partner in the deal, right? I mean, this is all part of building up your reputation over years to have access to the type of deals that you want to look at now.
Yeah, certainly there's a piece of that. We use software to find, deals that are non-performing, the debt that's not performing.
Yeah.
That's public information. Obviously, the banks want to get those non-performing assets off their books.
Yeah.
They will ultimately sell it to anyone, but they like working with certain groups, and we're one of those groups.
Yeah. I mean, it's different. That's different though, because you're using resources to find the opportunities, put them on the table for these banks that definitely don't want it. A little bit different than kind of what the handshake deals. Hey, I have a building that's coming up. Do you guys want this? This is a little bit more nuanced, and you're playing on the bank's need to get rid of something. But I would think that banks, at least in my residential experience, they're always so overloaded. They can have an asset that they need to get rid of and no one's paying attention to it. So you're kind of throwing them a life vest when they need it. Oh, actually, yeah, we'd love to get rid of this.
Yeah, exactly.
Because they're sitting with 10 of them and they don't know what to do. There's no one locally who's just looking to acquire that you can really kind of, be a good partner for them out of the blue.
That's what we try to do. But yeah, there's a lot of distressed deals that we want nothing to do with, like distressed office that can't be converted.
Yeah,
And
I mean, I don't know who wants that right now. Someone may have a vision. I mean, 10 cents on the dollar, okay, but I don't. Yeah, the non-conversion is obviously the problem because offices aren't built the way residential is built. So it's not an easy fix.
the footprint just isn't right to make
Yeah,
it into, just doesn't make sense. But
windows, plumbing, electric, all in the wrong places. I mean,
interesting story of a friend of a friend bought an office building in St. Louis, bought it for, I think it was like 10 cents on the dollar for the debt,
oh,
based on what the bank owned it for,
yeah,
because it was bank owned at that point. And what happened was it couldn't be rented. I think it had one or two tenants left. It was like 50 stories.
oh god,
No
zombie
one wanted
building.
it.
Yeah,
And so the guy said, went to the tenants who had whatever 5 years left on the lease or 3 years left on the lease, and said, "Hey, do you want to get out right now?" And they're all said, "Yep, yes we
yeah,
do, thank you, yeah." And then he went to his construction guy and said, "What is this stuff worth? What is all this metal and concrete and
yeah.
glass and all that? What's it worth?" And then he said, $10 million. I was like, "Okay, well, what's it going to cost to get it to the people who will buy it?" And they said $5 million. And so that's what he did. So
Oh,
he literally deconstructed an entire office building for the raw materials, and now, paid himself back what he bought the place for, and now still has the dirt in downtown St. Louis.
yeah. I mean, now you could go ground up residential if it fits. That's actually really interesting. I don't think a lot of people have thought like that because you just kind of think, just demo the whole thing or not. But sure, that's something my dad would think of. Oh, let's piece by piece, sell this puppy off. It's smart though. I mean, you have to be nimble and figure it out because if not, what else was he going to do with it? It's just going to sit there.
Right, exactly. I don't know that I would be building ground up multifamily in St. Louis.
Yeah. I mean, you have the land though, so
Yeah.
you have something available. But it's interesting though with the deconstruction of it, and you look at tariffs and anything that could happen because we really don't know. We're recording on April 29th. Day to day, I'm not sure what's going to happen, but materials are going to be really important, especially if they're going to be taxed at a higher rate coming in. So that's actually could be really interesting of a different move. It's just what you have to get it for the right price, the debt, like you said, to be able to deconstruct it and have it all make sense. That formula won't work a lot of the time.
Absolutely. Yeah. I mean, I think the bank ultimately wanted to sell it for something like 30 million and ended up selling it for like 2.
At some point, again, it's that guy in the back of the bank who's like, I just got to get rid of this. Like they know it. They just try to avoid it because there's too many. I remember when REOs residential were so popular. And even if you were in the bin where they knew you, it's just they just always say the same thing. I literally I just have way too much. I can't pay attention to anything. They just couldn't get it. Yeah, it's going to be interesting to see what's going to happen. I know multifamily kind of needs some fixes. Hey, it's Jonathan. I hope you're enjoying this episode with Austin Masket. On this brief interlude, I wanted to just give you an educational tip on syndications. If you're newer to investing, or if you've just never thought of going fully passive and investing in real estate syndications, the best way, in my opinion, to get started is to read Brian Burke's book, The Hands-Off Investor. I had Brian on episode 69, and as we go through the end of this episode and all of our other syndication episodes, that's a great book to help you get the lay of the land. Let's get back to Austin. But your overall outlook on multifamily, what do you think? As you were saying in your predictions, of course, at some point in the next few years, those are going to get rented and then rents will move back up. So multifamily as an asset, still great for the future, especially in affordable housing price.
Yeah, I think multifamily's certainly got a lot of legs left. Rents, we are going to run out of supply here, and then everyone's going to freak out and be like, how did we not see this coming? Just like we did in 2020 when we were like, we have 4.5 million too few housing units. That's still the case, right?
Yeah.
We put a small dent in that in 2024, and it all happened at once, so we're feeling that now. But at the end of the day, when you look at the major economic drivers of supply and demand, we're still short roughly 4.5 million units as a country between, single family houses, product to sell, product to rent, all that stuff. And in the long term, this was caused from the 2008 recession, still in play today. Still going to happen 2026 and 27. Let's talk again then, John, because I think we'll all kind of come to the conclusion that the data is just speaks so clearly. Yeah, and I think we're doomed to go through this cycle again, because in 27 people are going to say, oh no, we have to build as much as we possibly can right now, and then we'll have another peak, and then here we go again.
Well, I think, progressively people never learn their lesson from history. It's like when rates go down, don't just buy everything. That's not you have to still be more selective. But again, new people into the market. There's a lot of new money into the market, though, too, with, when I was growing up, there was no internet. So there was no, dot-com boom bust type of syndrome where you can, found a startup. All of a sudden you have $30 million and then you deploy it into the wrong asset because you just weren't used to being so financially able. And I think it's a different thing. Old money, if you look at Warren Buffett, like everything's slow and steady. New money is all different. It's like buy, sell, move, day trade. But real estate doesn't work like that. It's an asset that's been around forever. And I think people are going to need to look a little bit more historically at it to avoid what you're saying, which we know a lot aren't going to avoid it, but they could if they just took a peek.
Yeah, just buy right and don't ever feel like you have to pick up an asset, right? We always raise money on a deal by deal basis.
Yeah.
Because we don't want to feel pressured to have to spend capital by a certain date, because that's just a recipe for disaster in my opinion.
Yeah, I agree. That's why in general, just on the short term, I don't like 1031 exchanges just because I feel pressured into getting something. Like I think most people who do 1031s who don't have a trusted intermediary or aren't experienced with it, like you're just getting an asset because you need to move the money over. Like the timing is just going to run. You have to get something. So you get something that maybe isn't your favorite. And why are you doing that with a giant chunk of money? I mean, get something that you're, really excited about. But as we were saying, though, there's probably a lot of people out there with assets that they own. They don't even really enjoy them. They don't know why they got them. And I think that's something that people are going to need to solve as well.
Yeah, there's certainly a lot of that. I've done a number of exchanges myself for MS Holdings and whatnot, and brokers are always like, "Hey, we can get you this, X amount of dollars for your asset. Like, don't worry, we'll find you something."
Yeah, that's exactly what I want to hear. The time frame going down, I don't have anything identified, but sure, we'll get it done. It'll just
let's
be
roll the
something.
dice on that one.
Right. Yeah, I know. I do have a good risk tolerance after all these years in the business, but the larger you go, the more you have to really understand what your risk tolerance and risk mitigation is. Don't you think, especially when you're dealing now what you're talking about, debt and understanding what that multifamily asset. But I think a lot of people that we were talking about who bought into these deals and are in trouble, I don't think they paid attention to the risk tolerance because, as you were saying in the beginning, they just thought it was going to always stay like that and easy, which is just silly. The world doesn't work like that.
Yeah, people have short memories, and certainly, my generation just wasn't around for a lot of the high interest rate times, so they just figured 3%, that's average. That's just gonna keep going forever, and we may return to something like that here in the next 12 to 24 months, but I don't think if we do go down again to anywhere below 5 or 4%. It won't last long. It's just my thought, and obviously everyone has their own crystal ball on what's going to happen, but we'll see.
Yeah, and I think one of the hardest things for investors, a lot of people stay on the sidelines and don't look. Like you don't have to buy, but there's no reason to just say, I hate it when people say, I'm just going to wait till rates come down. I always say the same thing. Well, cool. What does your crystal ball look like? Because I don't know when they're coming down. You don't know. So what are you going to do? What if you wait 7 years for rates to come down and then you realize you passed on, 13 deals that could have been profitable? So as you were saying, you're not buying a lot, but you're always looking, right? That's part of being a real estate investor and someone involved in multifamily. You got to look at a lot of stuff and say, no, that doesn't work, because those people may come back around when they get desperate.
Absolutely. That's most of what I do on a day to day is taking a look at deals, underwriting them, seeing if they make any sense, and then, you know, and putting out offers. We do a lot of that. A lot of LOIs, I guess, not not bona fide offers, because a lot of times we don't. We get told no thanks, and that makes sense. That's part of the deal. We do maybe 3 to 4 deals a year, because that's a number that is, if you look at 100 deals, you might find 1 or 2 that are really make sense and that you can get a hold of.
Geographically, are there areas that you are more interested in than others, or are you kind of just really looking for something that's going to make sense for what you guys are looking to do at Riverly?
So our entry point is the most important thing. So it has to be, we have to buy it at a price that makes sense. We have markets that we like, Atlanta, Charlotte, Denver, Austin. Those are the most overbuilt markets that we've seen based on, new construction units per capita.
Yeah.
Denver is actually probably one of the more sluggish as far as absorption right now, which, over the last 10 years roughly, since the legalization of weed happened here, it's new for a lot of the people here.
Yeah.
This market has been so strong for so long, and now all of a sudden people aren't moving here as much. It's changed a lot, and I think if we found the right deal here or any market, it all depends on what you buy it for.
Yeah. Makes a lot of sense. Awesome. Austin, where's the best place for people to get in touch with you? Is it at riverlycap.com?
Yeah, riverlycap.com is great. You can sign up to be on our email newsletter. You'll get episodes like this and other content, as well as you'll get notifications when we do have a deal that we're putting out for syndication. And then also we'll have a number of ebooks and that sort of thing coming out here soon. So definitely jump on there and sign up to be on our newsletter if you want to get that kind of information.
Yeah, awesome. As I was scrolling on your site, I just saw the target markets: Denver, Atlanta, Phoenix, and Dallas. It's interesting because even with what you mentioned, of all of those, Atlanta's the lowest priced one. So I think it's kind of an interesting corollary to the others, because it's a big market, but price wise, it's not anywhere near, all of these other markets that we're talking about. So what you could get there, or the risk that you could take, might be leveraged a little better in a market like that if they're oversupplied and the prices are just so much better compared to the other markets.
Yeah, no, it's amazing. I mean, we look at like upper class C and class B stuff is what we like.
Yeah,
we want to turn a B minus into a B plus, or a C plus into a B minus. And Atlanta seems to be really well suited for that. There's like Colorado Springs, for example, is unfortunately built as mostly 1 bedrooms.
Yeah.
Most of the town is that way. Atlanta seems to be the opposite. So, we're definitely looking hard there. Actually, Seattle has shown a lot of promise as far as a lot of distressed debt. So, obviously there's markets we like based on the data, but if the entry point is low enough in virtually any major market, obviously we're not going to buy something in, rural South Carolina or something like that where there's just no people, because real estate doesn't work with no people. But if it's in the right market where we can turn it around and get in at the right entry point, then that's the deal we'll look at.
Yeah. Last thing, I think that BC idea is really smart, because as we were saying before, all the new builds are A. No one builds a C class. I mean, they're just going to repurpose it. So, and the C's aren't going up to an A. That money differential isn't working. So C's need to be moving around and go to C plus so they can bump it up a little, or even the B's, moving around. I think it's just made smart, and that's repurposing of existing assets, though, because you really have to play with what's out there and see what works. So it makes a lot of sense to me. Awesome, man. Well, I really appreciate the time. Glad you got on here and spent the time with us, and I look forward to staying in touch.
Absolutely, Jonathan. Thank you so much for having me on. It's been an absolute pleasure. Looking forward to chatting again soon.
Absolutely. That was Austin Masket. He is the Chief Investment Officer of Riverly Capital. Again, you can find them at riverlycap.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you could get a preview of who's coming up on episode 258 of Zen and the Art of Real Estate Investing. And it's Andrew Cushman, the founder and principal of Vantage Point Acquisitions. Andrew's a former chemical engineer who left his corporate position in 2007 to get into real estate, started off flipping in Southern California. You can probably figure out which way that went, but he figured out what to do, and how he got into multifamily is the story that we talk about. We'll see you next episode with Andrew.